Good morning, traders. Chris Buss here with Traders Profit Compass with your morning look at markets for Friday, July 16th. I'm going to make things real simple as far as looking at the futures go and just say everything is flat because there's nothing much there to even talk about. On the macro front today, we've got July OPEX. So please review any open option positions that you have. Make sure nothing has slipped through the cracks. You don't want to wake up, Saturday morning and find out you've got 1,000 shares of something you had no idea that you had. I hate those kind of surprises. So check everything today. Make sure you've got a plan to either, roll your position if it's something that you want, or close it out and then head into the weekend, with that option position taken care of. Other things we got. University of Michigan consumer sentiment, and we've also got retail sales this morning. Now it's 10 minutes to 7, which is at least an hour later than where I'm used to recording the video. No, that's not because I slept in this morning. It's because I've actually been working on something. If you've been with me a while, you know that I've been saying for weeks, I will let you know when to pay attention. I think that time has come. If you're if you're new here, welcome. Hit the subscribe button, hit the alarm bell. You'll get all my content, all that good stuff. Longtime listeners, thank you for supporting me. Pass the link along. I'd really appreciate it. So let's get into why I think now is time to pay attention. First of all, what does pay attention mean? It just means that. It's not a doomsday scenario. It's not liquidate everything. It's not hide under your desk. It just means pay attention. You're coming up. You're on a summer vacation. You're looking at the maps, you're following GPS, and there's a big fork in the road, right? I've been used to taking that trip up 75, and there's usually you don't have big forks in the road when you're on an interstate, but there's a couple places on 75 where there's construction, heading into Tennessee. It's a mess up there, big fork in the road. You can get boxed out. You got to pay attention. So this is, are you going to go left or are you going to go right? And you get on the wrong side of the road, and as busy as that traffic is, you may end up going the wrong way. So that's all I'm saying. Pay attention. Look out of the windshield. Get rid of the distractions. Why? I got a whole raft of reasons here, and this is a preview of the blog post this morning, but I didn't want to miss one of these reasons, so I want to knock this out as quickly as possible, and just to give you a flavor of what I'm looking at. Today is July OPEX. When you come out of a monthly options expiration, things can get volatile the following week after all that gamma and delta roll off. Now the market next week will have quote, the ability without all those technical forces to find a new level. That could be higher, that could be lower. Yesterday, we had a wobble. SPY and QQQ are testing their uptrend lines. Now, those uptrend lines held yesterday, but it's the first real, trend line test we've had in a while. And simply for that reason, if we were to have a decent down day today, we would be below, and that would be at least another reason to pay attention. And depending on how tight you want to run things, it'd be a sell signal. Why? You break an uptrend line, you drop below the 8-day, you drop below the 20-day. That's a sell signal. So we're not there yet, but we could be with a bad day of selling. So be careful. Bearish divergences, they've been present for months. Bearish divergences often point to a change in trend, but they're yellow flags. They're not red flags. So, but taken together, if you have a trend line break coupled with bearish divergences, that gives more credence to the signal. So pay attention. Seasonality. We made a point 3 weeks ago saying that, number one, the lead up into earnings is bullish. Number two, the first 2 weeks in July are historically since 1950 the most bullish on the calendar. Today is the end of that 2 week period. So now we go into August. And if you thought July volumes were light, wait till you get to August, because last year, because of the pandemic, there were no summer vacations. People were not out on the road. They were locked down. They were buying boats. They were buying pools. They were fixing up their house, doing whatever they do. This year, they're going on vacation, and that includes traders. So I expect volume to go down. And when there's light liquidity, anything can happen. It doesn't take a lot of money, relatively speaking, to push the market around when nobody's home. So August could be a volatile month just for the fact that there's not going to be a lot of active trading activity. FOMC, we got 2 big meetings coming up, end of July and then Jackson Hole in August. I don't expect them to signal any tapering in July, but with these inflation prints, who knows? There would be a much higher probability that they do something in Jackson Hole. We've got the debt ceiling. Lawmakers are going on vacation, basically for the month of August. That's usually a nothing burger until it isn't. That's not a big reason to be concerned right now, but it is out there. It'll be something that we face in early September. As you know, Brett stinks. We've only got 42% of S&P stocks over their 50-day moving average. And if we were in a bull market, you'd expect that and want that to be a lot higher. Cautionary. We got Fat Man earnings. What is Fat Man? Facebook, Apple, Tesla, Microsoft, Amazon, Google, Netflix, all that stuff is all going to start reporting. We got Tesla and Netflix next week, and then we got everybody else the following week. Now, we've been on a good run, and we've been in the right things. Why? Because Fat Man's been going up, and basically everything else has been going down. But we had a wobble yesterday, and I'm not saying, they could be all up 2% today. I have no idea. We still got another week to lead into their earnings, and I'd like to think that week will be bullish. We can buy short-term calls. We can participate in that if we want. But after earnings, when Fat Man reports, one of two things is going to happen. It's either going to go up or it's going to go down. And if they resolve higher, then the broad market averages go higher. If they resolve lower and it's a sell the news event, then we go down. It's just the math. At 25% of these indexes, SPY and Q, or definitely QQQ, but a large weighting in SPY as well, if they sell off, they're going down. It's just that simple. And then we've got earnings at large. All the banks that reported this week, for the most part, beat all their numbers. I haven't looked at each individual name with any kind of focus, but I think they're all down. Goldman, JP Morgan, Citi, all those guys, and financials at large went down, and they went down on good news, so that's never good. Now and we're entering earnings season, so we're going to have a lot of turbulence on, number one, high expectations. Number two, how does the market react to the earnings? I mean, if you blow it out of the water and then something sells off, then you answered your own question, right? that's bearish market action. If the opposite happens, and there's positive price action after earnings, maybe it's much ado about nothing. But the expectations are high, and there's been a lot baked into these prices, so it's something that we're going to have to pay attention to. Semiconductors. Terrible, terrible price action. We've been focusing on this every morning. Yesterday, they pulled the rug almost 3%. And we've had 2 fake breakouts over the last 2 weeks. We've been focused on this $35 consolidation range. We had a breakout last week that failed. Now they bought that up, and then they broke it out again. And then yesterday, they pulled the rug again. That is not good price action. Semis are a risk-on, risk-off asset class. And if I just don't see the cues, apart from FATMAAN doing all that much, if semis are getting knocked down 3% and can't break out. So I don't like that. Small caps. We've been looking at those every day. They've obviously rolled over. They are below the 50. They're below everything except the 200. And it looks like they're running down towards the bottom of their consolidation box. So, you'd like to see small caps stabilize and reverse. They too are usually viewed as a risk-on, risk-off asset. And as we've discussed, those are all, cyclicals, regional banks, reopening plays, cruise lines, airlines, all that stuff. If that resolves higher, then great. IWM will stabilize and we can get long near the bottom of the trading range, and that would put us in a great position for the fall. But if you look at that chart, and we're going to in a minute, could be a massive top if that trading range breaks. So again, time to pay attention. Now, oscillators, NIMO and NAMO. And I'll show you this when we get into the charts, but they're almost oversold. They're showing that we're almost oversold at all-time highs. How is that possible? Well, they're measuring. They're not measuring the indexes. They're measuring all the stocks in the in the NASDAQ and in the NYSE. So here we are. I'm saying pay attention. We're at a crossroads, and the oscillators are seemingly indicating the correction, quote, the correction is almost over. Could we go lower? Sure. The oscillators do not provide a pinpoint, flip long today. But what it does say is you don't want to be piling in short on the average stock. And if you've been a guy that's been crafty and you saw some of these sectors sell off over the last 6 to 8 weeks, and you've been participating on the downside, you should be certainly looking to roll your positions down, take profits on all that stuff, and be ready to exit. You should not be piling in long into the hole and then just in time for the snapback rally. So if you've been killing it on the downside over the last month, congratulations. Be looking to lighten up on those positions because the oscillators are oversold. Sentiment. There aren't any bears out there. And when there's no bears and everybody's already in long, that's a recipe for a rug pull because there's not going to be any air brakes. There's not going to be anybody buying in August if they decide to pull the rug. So pay attention. All that being said, may not matter. There's still Fed liquidity. They're still buying. They're still pumping. Where's the money going to go? So that's a check mark for the bulls. You also may have read that the Treasury General Account, that's basically their checking account, they've been drawing that down from over, $1.8 trillion. They want to get that down to 500 billion. And according to their timetable, they want to be done with that in 2 weeks. So over the last month and a half, 2 months, they've been pumping in about $1 trillion in liquidity over that time period, and just flooding the market with money. And so in 2 weeks, that's going to be that spigot is going to be turned off. Now, does that mean a rug pull? I don't think in and of itself it means that, but less liquidity is less liquidity. So I think there's enough there. I hope you agree to pay attention. And like I said, I know we all try to pay attention every day, but put some exclamation points on the back of that if you need to. I think now is a time. We're going to be coming up to that big fork in the road very soon with construction and all kind of crap going on around us. You don't want to be distracted, so let's take that posture. I'm going to go through this very quickly. We're already 15 minutes in. So dollar consolidation range, watch the top, watch the bottom. It's going to mean a lot, especially to the the commodities, the precious metals, cyclicals, all that kind of stuff. For those of you that are new, we've got 2 scenarios here that tie the dollar in with yields, and usually one of these regimes take over. And we've been in scenario 1, we've been in FATMAAN, we've been winning. I like that, but there's been a divergence lately where these bubble stocks and EV and solar have not participated as they were earlier in the year. So got to pay attention here. Yields. We've had a round trip between 140 and 130 on the 10-year. We've done that twice. Breakdown to 130, bounce back to 140, and now back down to 130, all in the course of just a couple of days, maybe a week to do that round trip twice. So, now we're down at the bottom of the range. And whenever you're at the bottom of the range, you got to pay attention, because that support, you break lower, that's something totally different than holding the line and staying in a trading range. You break 130 and you stay there, that's a big deal. TLT, we caught this bounce. We finished at the highs. I looked pre-market. We were down, $1 or 75 cents, something like that. I still think you stay long against the 200 here. I rolled up my position. So now I'm out in July 30th. I went out an extra week and I rolled up my position. So I took profits on this move. I'm staying long, and we'll see how it goes. Oil, corrective action right here. The only thing to do here is watch it, because it is highly correlated with SPY. Falling oil is bearish, SPY. It's just the correlation. Here's the oscillators that I was talking about. This is NYMO. This is the Nyse Mcclellan oscillator. We're down here at minus 47. Usually at minus 60, you can see all the reactions. Here, 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 all the way across the line. You can see that when it gets to minus 60, that's a place where you want to start unwinding your shorts and getting ready for a bounce. Now, the thing of it is that, it can overshoot. Here was a minus 80, minus 80. Back in March, it went minus 140. So it's not a thing where on a Friday afternoon, you can just say, okay, time to go bullish. We can put together other indicators, but it's very good at telling you when you're stretched. This is a rubber band. You get down into minus 60. That's not a time to be piling in short and be a Johnny-come-lately short into the whole guy just in time to get your face ripped off. So pay attention. Same on the NASDAQ. We're at all-time highs. If you told somebody right now, hey, we're oversold on the NASDAQ, you might get laughed out of the bar, right? So, but here we are at minus 57, right at that level where you'd expect a bounce. How could that be possible? There's only 5 names holding up this whole market in FATMAAN. So you look under the surface at Zoom, DocuSign, Solar, EV, all that stuff. They've been getting whacked. So there's semis. They're not doing anything. So, under the surface, there's been selling. We just haven't seen it yet on the top line averages. So here's a scenario. What if now FATMAAN, they're all going to blow the earnings out of the water, right? We know that. They do every quarter. But what if they go higher out of earnings? And what if all these oversold everyday names in the NASDAQ, they're oversold and you get the oversold bounce? I mean, that's a recipe for going higher. If FATMAAN resolves higher, and these average stocks are oversold and bounce, we could go a lot higher. So anyways, that's just one scenario. Let's get into the indexes. I'm going to go through this real fast because we spent a lot of time on it in the prior weeks. We tested the uptrend line yesterday. It held. We're right at the 8-day, right on trend. Could we bounce and go way up here? Sure. Could they put in a good day of selling and get that technical violation? Yes. That's why we need to pay attention. Here are the bearish divergences. We're at the highs, but at relative lows in momentum and RSI. RSI doesn't matter until it does. So keep that in the back of your mind. SPY 2-hour. This was a bad look. We broke into the prior trading range, and our TA principles say once you enter a prior trading range after breaking out, that makes the breakout look fake. And all we did, just from a technical standpoint, is we broke down, and then it was a strong close. We back tested the breakdown. That happens all the time. So, from a technical standpoint, we get rejected here today and come back down here, then it looks relatively bearish. If we break out above 435 today and close on the highs, fill this gap, run up here, then it looks like, another head fake. Pay attention. Could go either way. Use that 435 as your pivot point today. Here it is on the 30-minute chart. Same technical look. You've got a gap up here to fill. Let me just offer up a scenario. We open strong. We have a strong morning session. We race up here. We fill this gap. We come up here, and then we roll over. That's that idea of taking care of unfinished business. The gap, get up to the gap, roll over, and finish low into the close. That's just one scenario. I have no idea, but be ready about that. And if you catch this long here this morning and you get that gap fill, that's a time to really put up your antenna. I would certainly be taking some profit there. It's fine if you want to, you get that breakout at 435.50, stay long, and then see if we get a strong close. And that would be, some good active intraday trading if that's your thing. Moving on to the Qs. Here you can see we've got this intermediate trend line. I did add a channel line here at the top. I should have done that a long time ago. But, we're in the upper part of this, and yesterday we tested this trend line. We took a look below the 8-day in pink and we recovered it. We got a PPO, flashing potential bear cross. We got RSI, flashing potential trend line break. I wouldn't say those breaks or this rollover is confirmed, but you get a high level PPO rollover coupled with an RSI trend break, coupled with a break in trend. Pay attention, because that's when things start to go bad. So keep that in mind. 2 hour. That was a pretty significant break yesterday from 262.50. We came right down to the level that we were looking at towards 358, 358.50. Got a bounce into the close. This morning, active trading, I think you can look at 360.5 and then toggle it from there as your pivot point. Obviously, just with everything we've been talking about, you don't want to lose yesterday's low. You don't want to lose 58.50. What was the low? 58.46. You don't want to lose that low, because then you're going to come down to back test this prior low down at 354.5. And, if you're an active trader, that's a place where you would want to take that tactical short for that several dollar move. Here's just the 30-minute chart zoomed in. You can see here that you can toggle at 361. You break above that and get up in here, that would be bullish. You lose yesterday's low, just like we talked about. Then you're coming down in here towards 355, and then that would look like, finishing the week on a bearish note, finishing at the lows. That, is never a great thing. Here's IWM. Put in a hammer yesterday, but, way below. Now we've got the 8-day below the 50 and the 20. That's a bearish look, guys. It just is what it is. And we're down in the bottom third or 25% of this trading range. Just from a technical standpoint, why would it reverse here? Why not just come down and tag, make another check of that low, these lows here, and just go to the bottom of the box? I mean, that's been the cycle. Top of the box, bottom of the box, top, bottom. Yeah, I think, getting something down in here would be great. Can it reverse here? Sure. Could we bounce and then go down Monday? Anything can happen. All I'm saying is this is a bearish look, and I wouldn't be surprised if we come into 212.50 and test the bottom of this box, and then big time decision. Why? Because, while we were looking for a breakout here for, looking for a $23 upside target, you break down here, same thing in reverse. Then you're looking at a measured move, $23 lower than 212, and then you're looking at 190. So, and then that would make this look like a 6-month top, and that wouldn't be good. 2 hour chart, you can see it here. We had all the levels. I mean, we've had all these levels. What you did with it, I have no idea. I'm embarrassed to tell you that I didn't capture hardly any of this. And, that's all discussion of why. Were you distracted? Were you trying to get cute and get bullish when the whole thing was bearish? So anyways, got a bounce here at 215, came back up here. You get a bounce into 220 here. There's a resistance level. That might be a logical place for it to get rejected and come back down or break out. So these are definite reaction levels. Recapturing a level from below. If we break above here, this 218 this morning, you can look for 220. If you take out 220, you can look for 222. So those are bullish, recaptures from below are bullish, and also potential places for a rejection. Not going to spend any time here. 30-minute chart just gives you the zoom in. Let's go on to FATMAAN names. I'm talking fast. Going to try and get you guys out of here. Terrible action in Facebook. I mean, just terrible. Back up to the top of the range, came back down. And if all your aspiring TA guys, technical analysis guys, look at this. Here's leg one from, let's just call it 356 to 348. Here's a flat flag, and here's your measured move down to 340, and then you get your bounce. So I think today you can use 344 as your pivot, and you sure don't want to see 340 break, because then you're back down in here, and your measured move target is going to be all the way back at 320. What is that? 330. So that would be a very bearish outcome. But I mean, that almost looks like liquidation. I mean, when you lose $15 in just a couple days, that's not so hot. That's not what I was looking for. I was looking for the breakout. Apple, been strong. Had a little fake breakdown here. That coupled with what I was seeing other places got me out of my short-term calls. And but longer term, it's still fine. We've broken out. It recaptured that level. It's above trend. I would just say pay attention like everything else. They may rip this thing into earnings that are in 2 weeks. And, I will be back in just tactically, not any kind of massive long-term deal, but just tactically. If they want to ramp this and blow it out of, take out 150 and go, I want to be on board for that, but I'm not going to be hanging around long, and I'm going to stay on my toes because, if Facebook's selling off and there's turbulence elsewhere, then it's going to be hard for that to just, go on a solo run. Disappointing price action in Tesla, could not break out, has over the last 3 days lost these levels. If you lose 640, you're coming back into 625. If you break out above 655, that opens the door to 670. Use that 655 as your pivot today. Microsoft, been holding the line at 280 like a champ right here, and that's your go, no-go line. It looks like there's responsive buyers there. You got to hold 280. And if you're in, any kind of longer term, what I mean longer term, if you're in calls for earnings, that's fine. You took some heat yesterday, but you didn't die. And what I mean by that is you didn't lose 280. If you lose 280, you got to get out. Why? Because then you're going to come back in here to 277, and then that'll make this price action look fake in the sense that you were below the channel, had a nice move back in, had a push higher, and then failed if it comes back down below 280, back into 277. So I think 280 is a big line in the sand for Microsoft bulls heading into earnings. Amazon, disappointing. We had this bull move, we had the bull flag, and yesterday it lost it. So now we're down here. I would use that if you want to fine tune it, yesterday's lows, but I mean, realistically, you're looking at 3610, let's call it. If you want to round it, 3600. You lose 3600, you're going to lose 50 bucks. You're going to come back in here, maybe even more. But that was the breakout level, 3550. And as a lot of guys in the chat room have been talking, that would be one of the most bearish things you'd ever want to see in big cap tech. I mean, we've all been looking for a move to 4,000, and you get a breakout from 3550 that was a year in the making. I'll show it to you here. This consolidation's been a year in the making. You get a breakout up here, and then you come back and you lose that, and you come into this, back into this $600 trading range. Oh my God. Oh my God. Because the technical target is the bottom of the range, right? I mean, that just is what it is. That doesn't mean it's going there, but it's certainly not bullish. And, you know, a back test is fine. That gives you a second bite at the apple, and then everything resolves in September or in 2 weeks. That's fine. But you get into 3,500 and you get into 3,450, no, not buying that. You know, that would put you below the 50, and then it might be game on selling. And remember what happened. This was earnings last time. And I don't know if it's Jeff, or I don't know if it's Mackenzie, or I don't know if it's the both of them, but they liquidated that earnings. You got that big pop, and they just sold the crap out of it. They took it from 35.50 down to 3,100. They pulled 400 bucks out of that in about 2 weeks. So maybe Jeff will be in space and he won't be able to sell, but I don't know. So watch that like a hawk. Netflix. We got the gap fill, and now we got a fake breakout, and then they liquidated it. So we're back in the range. That's not particularly bullish. You got to recapture 550, and then you got to get back up here to put this back on track. You see a bad down day here soon, you could come all the way back to 515. Why? Just for the same reasons that we just talked about. Fake, technical move complete, gap fill, fake breakout, back into the range, selling. We got unfinished business way back down here with an open gap. Could come back to back test this breakout at 515. That's not what we really want to see. And now Google lost its 1 hour trend line. Got to hold 25.30 today. Use that as your pivot. Above, there's no problem. This is that breakout and back test scenario that we were just talking about. Break out of this range, come back to back test it, get a bounce and follow through in the days ahead. No harm, no foul. If they sell it off, then all those same comments apply, that your target would be 24.80 on a down move. And here's the one that's been particularly disappointing. Semiconductor group, big consolidation range, breakout, fail, breakout, fail. Now you got to use the 50 as your toggle point if you're trying to actively trade it. But for instance, if you lost 250, then you could get short against 250 and look for 240, and potentially, if everything falls apart, back here to 223 at the bottom of the range. on a technical move, bottom of the range, top, bottom, top with a fake breakout. I mean, technically speaking, the door's open for a flash to the bottom of the range. And if we lost the 50, you only got the 200 way down here. And then again, that would make technical sense. I'm not calling for that. I'm not making a bold prediction. I'm just laying out that we've had 2 false breakouts, and they both failed. 2 attempts to get out. I was long in both of them. I took my paper cuts. I got out yesterday. Look at NVIDIA. Look at AMD. Look at Micron. Look at Intel. Look at LRCX. They all look like crap. AMD was all set to break out. It failed. They pulled the rug on NVIDIA. The rest of the group doesn't look hot, and that's why this breakout failed. I mean, this is just a composite of all the stocks in the group. So I hope, we're at 40 minutes here. I got to pull the plug. I could talk for another 3 hours. But I just wanted to give you a comprehensive look at pay attention. It feels like an inflection point. I'm not prepared to say, gonzo short or pile in long. We got mixed signals. We got construction all around us. We got traffic on the streets, on the roads, and we don't want to get boxed out. So I'm, neutral. I've taken risk off. I shared that with you yesterday. I am more than happy to pile in long. I am more than happy to get short, and it might be a combination of the two, but I don't think at this point you want to be on one side of the boat and, committed to some kind of thesis. I think this is the point where we got to do our best to look at the signals over the next 2 weeks or however long it takes and be ready to go, because if it breaks higher, we got plenty of time to get the next leg higher and make a lot of money. And if it breaks lower, same thing. We got plenty of time. If sell signals fire across the board and they're confirmed, you can make a lot more money on the downside over a given period of time than you can on the upside. Staircases up, elevator down. We catch a down move, then feather in our caps. But I don't think it's time to make that call. Let's wrap it up. Hope you have a good day of trading. This has been Chris Buss with Traders Profit Compass. Talk to you next time.